Well, thank you. Good afternoon, everybody. This feels a little bit like the seventh inning stretch. So I'm just a brief 15, 20 minutes, but I'm going to shift gears here. Most of today we've talked about the portal side of things. I'm going to talk about the other side of the equation, and I'm going to talk about investors. But no, I'm not going to talk more about investor protection and the SEC looking over our shoulder. I'm actually going to talk about investor opportunity. And I want to preface 2 points. First is that when I talk about investments today, I do so with a background of almost 2 decades on Wall Street, at one time managing almost $500 million personally of money. So today I still stand up here, and before I open my mouth, 6 words still come to the front of my mind, and that's yes, Your Honor, no, Your Honor, before I ever say anything about an investment. With that said, I talked about this today in terms of your typical asset allocation and diversification opportunities. The other thing, the goal I want to leave you with today, whether you're a small investor, a big investor, or a money manager, is in today's markets, where are you putting cash? Where are you putting money? And I'm going to very briefly speak about a personal experience. I recently received what they call an inherited IRA or beneficiary IRA. Now, it obviously was set up on the fixed income side of things. So when I met with the broker at one of the largest brokerage firms in the world, with the branch manager, he's supposed to be one of the best in terms of education, sat down and we went through Rule 405B, know your client, and he said, okay, well, you fill in to the cookie cutter of 60% equity, 40% debt. So what I'm suggesting is we liquidate this IRA and we put 60% of your cash, we're going to average it into the market, this was back in June, over the next 3 months. And I said, well, I don't want to be a pain in the client, and I know the drill, but at this point, when the market is reaching all-time highs at the beginning of the summer, I'm not secure with averaging 60% of this IRA into the market at all-time highs. So he said, all right, well, let's shelf that. Let's talk about fixed income. So he said, okay, well, we've got some synthetic ETFs. I'm not sure I know what that is still. And they return about 2.5%. And I said, okay, and your management fee is? And he said, 1.5%. So today, with the market at all-time highs, we're going to attack Syria, we're raising interest rates, which means that's crushed the commodities market, which has crushed the emergence markets. Where do we put money today? So what I'm going to talk about the investor side of things using retirement dollars. And the key role that self-directed IRAs has been seeing in this industry for the last 1.5 years. We've heard about it all day today. The number one issue for portals is attracting investors. The number one issue for investors is relative return with tax efficiency. Another quick aside, when I was at Merrill Lynch in the trust department, the majority of family money estates that were crushed were not from a spendthrift son or grandson, it was from taxes. The biggest factor that investors face today is tax efficiency, whether it's taxes due this year on annual taxes or when an estate settles. Because the problem is when a tax bill comes due, there's never enough liquidity to cover it. So that forces the fire sale of assets, businesses, real estate, etc. Over and over, because of the poor tax efficiency of investors, they get burned. And then just a quick reference to Congressman Schweikert spoke at an event in Atlanta last year, and he talked about the coming fiscal retirement cliff. And he's a big proponent, as you might know, of crowdfunding. So I'm going to make a couple references that might get you thinking about this. So, how many people here have invested in crowdfunding? Any investors? Okay. So if you have, you might know that you can't take your IRA at Fidelity, Schwab, E-Trade, and invest into crowdfunding. Because the IRAs that we know today with brokerage firms can only buy stock-sponsored mutual funds. So the quick definition of a self-directed IRA is a platform that allows you to invest in alternative assets, i.e. crowdfunding. Self-directed IRAs are available in all of the IRAs that we know about. Traditional IRAs, which means you're putting money in after tax, Roth IRAs, meaning that that money has already been taxed from income, but will forever distribute tax-free. Company profit pension plans, 401ks, health savings accounts, and Coverdale educational accounts. So we talked a lot about the categories, so let's just highlight. For self-directed IRAs, you cannot use them to invest in donor or cause-based. The reason being is there's a personal issue tied to that, and it's not an investment. Self-directed IRA, just like any IRAs, can only invest in securities. The incentive or pre-purchase, the Pebble Watch, also the same. Your IRA invests in the asset, but the Pebble Watch means you, the IRA holder, uses it, wears it, receives it. There can be no personal benefit of the IRA holder for the self-directed IRA. So really the two categories that we see today is peer-to-peer lending, and as we talked about, the accredited investor Reg D. The attractiveness, or rather how to attract investors to portals, once again, maximizing the attractiveness of the offering. The number one challenge, we heard typically 30% is what investors, or excuse me, people that are raising funds are able to bring to the crowd. Well, getting to that second, third generation and accredited or wealthy investors is done through self-directed IRAs, and we all often will re-engineer the relationship with the wealthy investor to bring it to a portal to use a self-directed IRA. Offering investors return with tax efficiency. Again, we talked about it, but what's interesting, and I heard Ron Suber talk at the Lend 2013 conference, and I'm hoping to hear some more. It is absolutely one of the best presentations I ever had. But what woke me up to this was the fact that institutional investors, family offices, wealth managers coming into this space to try and get these same kind of returns for their clients. At the same time self-directed IRAs have becoming popular, we also see the growth of alternative investments. McKinsey & Company last year released Mainstreaming Alternatives, pretty interesting study. These are two of the highlights. From 2001 to 2011, alternatives returned almost 15% versus a little less than 2% from the S&P. As well, institutionally, it's estimated that portfolios are going to climb to a little less than 30% of every portfolio. So people need to be looking at alternatives. And obviously the tax efficiency is the biggest draw. Keep in mind that with a Roth, whatever you invest in, you're never going to pay taxes on that. So the process offering self-directed IRAs quickly, it's as simple as creating a link to a portal. An online application is generated in an hour or two. The transfer, which can be cumbersome, is started instantaneously. The bi-direction letter is what generates the investment into the portal. So, why isn't every portal offering self-directed IRAs? Well, that's something that I'm personally working on, but the reason to begin with is the awareness. Many of you today may have never heard of a self-directed IRA. The reason is, the answer is, typically they make up 1% of the $6 trillion retirement industry. And why? Because in 1975, Congress created the IRA because they foresaw the coming end of pensions. So they created the IRA and gave us tax incentives to save for our retirement. Well, the folks that were in the pension business, banks, brokerage firms, mutual fund companies, and insurance companies, moved over into the IRA space. So when we think of an IRA today, we think about an IRA at a brokerage firm. But when the IRA was created under a little known code, 4975, under the IRS, you can actually invest in anything other than life insurance and collectibles, specifically crowdfunding. Number two, your brokerage firm doesn't offer them, they can't offer them. And again, most brokerage firms today are paid by assets under management. So if you go call your Merrill Lynch broker this afternoon or E-Trade and say, hey, I want to use my IRA and buy some of these, they'll say, well, no, you can't invest in. And number two, say, well, gee, I'd like to bring that to an IRA custodian. And they'll say, well, no, you don't. You really don't want to do that. It's risky and all the reasons that you hear. But again, it's not in their best interest or incentive to ship assets out the door to invest in other alternative assets. The process is not or cannot be as simple as described. For those that have used self-directed IRAs or have experience with them, if they're not with the right provider, it can be very cumbersome for a very simple reason. When we buy a mutual fund through E-Trade or Merrill Lynch, there's a CUSIP that underlies that investment or asset, and it's automated through the exchanges. Well, in the self-directed world, you, the IRA holder, are directing each and every investment. So each and every transaction is separate. And if it's not done right, proper gating, proper signatures, etc., it can be a really cumbersome process. So the right provider can make or break a deal. And then lastly, it was interesting, I mean, everybody reads the Wall Street Journal and sees, every few weeks that we have the coming fiscal crisis, that Social Security, Medicare, Medicaid is going to bankrupt us anywhere from 2022 to 32. But when Congressman Schweiker said that it's very real and they discuss that every day, it really kind of rang true and said, we're in serious trouble. So when we take a look at retirement portfolios that got crushed in 2001 and 07, 08, and again in 09, home value still down 30, 40%. Again, we referenced the number earlier. Where are we going to reach our retirement goals? And again, this is just some what-if numbers. But think about it. Crowdfunding can do more than create jobs. It can fix the coming retirement crisis. Believe it or not, the average IRA profile is a 50-year-old with $100,000. If you were able, through some of the peer-to-peer lending platforms and other providers that are offering close to double-digit returns with less than 1%, that $100,000 IRA could be worth $1.4 million at 70.5. As well, the health savings account, that's not a flexible spending account. A health savings account, a family can contribute $6,000 a year to, and through a self-directed IRA platform can invest in crowdfunding options. Over 30 years with those contributions and returns, it's over $500,000. As well, Coverdale educational accounts could be worth over $180,000. So to put it into some perspective, when we talk about retirement planning and self-directed IRAs and crowdfunding, there's a real opportunity there for portfolios to allocate a portion of those funds, be it equity or fixed income and peer-to-peer lending, to consider.